While everyone panicked about the DOJ threatening Fed Chair Powell this week, disciplined investors recognized something far more exploitable. The market's psychological fracture was creating systematic rotation opportunities that most participants completely missed. The crowd saw chaos where we see predictable human behavior playing out exactly as it always does under institutional stress. Here's what actually happened this week and why it matters for anyone serious about systematic wealth building. The S&P dropped barely 0.1%, yet beneath that calm surface, over 300 stocks rose while the index fell. This wasn't distribution, this was recalibration. Capital wasn't fleeing equities, it was repositioning within them, following patterns we've seen countless times before. The Russell 2000 outperformed large caps for 9 straight sessions, matching the longest streak since 1990. Energy hit new highs while oil stayed flat. Gold surged to records while bonds held steady. These aren't random moves, they're the systematic unwinding of overcrowded positions meeting the systematic building of underweight allocations. Human psychology created this exploitable moment through 3 predictable behaviors. First, cognitive dissonance resolution. When the DOJ probe threatened Powell, investors faced existential anxiety about central bank independence. Rather than process this rationally, they resolved the discomfort by selective attention, acknowledging the threat, then acting as if nothing changed. Second, narrative preference shifting. The same investors who justified AI valuations for years suddenly found permission to chase cyclical value when energy provided a new story. Third, zero tolerance for disappointment. JP Morgan beat earnings but missed investment banking fees and dropped 4%. At these valuations, perfection isn't priced in, it's demanded. The system responded with structural rotation rather than broad capitulation. Technology bled capital not from fundamental deterioration, but from mechanical profit-taking after parabolic runs. NVIDIA's China restrictions introduced actual revenue risk into a pure growth narrative. The Magnificent Seven declined while market breadth expanded. Classic late-cycle dynamics where exhausted momentum seeks new outlets. Energy's breakout carried deeper significance. Exxon hit all-time highs in an environment where crude offered no fundamental justification. This revealed portfolio rebalancing after years of underweight allocations. The sector traded below historical averages while offering positive technical momentum, textbook mean reversion in action. The bond market held 10-year yields near 4.2% despite dovish data, signaling term premium expansion independent of rate expectations. This reflected either inflation persistence or supply-demand imbalances, both supportive of hard asset positioning. Macro data painted deceleration without collapse. CPI at 2.7% year-over-year, core PPI flat, payrolls at 50,000 versus 73,000 expected. This combination supported the no-landing scenario where growth slows just enough to contain inflation without triggering recession. The disciplined response recognizes that uncertainty is the only certainty. This week provided no clear directional signal, only confirmation that multiple scenarios remain viable. The market absorbed negative surprises while maintaining structural integrity, suggesting underlying strength. Yet narrowing leadership breadth and rising geopolitical noise suggest fragility. Both are simultaneously true. What matters isn't predicting which force dominates, but recognizing the current equilibrium is unstable. Volatility compression precedes volatility expansion. Complacency precedes repricing. The rotation from growth to value, mega cap to small cap, technology to energy represents prudent rebalancing in the face of rising uncertainty. The Stoic approach acknowledges this as a condition to accept, not a problem to solve. When institutional credibility becomes a load-bearing assumption, and that assumption wobbles, participants must reassess the entire risk framework. The market's recovery revealed resilience, but underlying fragility remains. Gold's record highs reflected simple calculation. When policy uncertainty rises and real yields stay suppressed, the opportunity cost of non-yielding assets declines. The simultaneous strength in gold and equities isn't paradoxical but rational when both respond to the same monetary conditions. The system rewards those who recognize that markets remain structurally long volatility through positioning while behaviorally short volatility through complacency. This mismatch creates conditions for sharp reversals when catalysts emerge. History shows humans consistently choose narrative comfort over analytical rigor. The crowd reacts emotionally to surface-level moves while missing the systematic rebalancing underneath. We remain disciplined, recognizing that conditions change and those who adapt survive while those who extrapolate suffer. If you value systematic thinking over emotional noise, Subscribe for frameworks that exploit predictable human behavior. Download the complete Stoic exploiter methodology in the description, because markets reward discipline, not drama.